Hello, everyone. Hopefully you're having a good day. My name's Andy. My channel's Finding Value. And if you're looking for undervalued investment opportunities, financial education, answers to your questions, if you have questions, put them in the comment section. I'll try to answer them as best I can. Again, I don't know everything, but I've been around the market for 18 years, maybe 17 years, something like that. I've been in the market and I've learned a lot over that past 17 years. And we've got some questions here that I'd like to answer, and I'm going to answer it so everybody understands. One is a market cap question, and another one is tied to market cap. It says, do you not mostly buy companies with a market cap over 1 billion, Andy? I look at NXE, DNN, PALAF. These are all uranium companies as solid companies moving into the uranium bull market. Yet I worry the future return may be less because of their large market cap. Would appreciate your opinion on this. So what is market cap? So when you go and you look, I'll walk through it a little bit right here. It's not too hard to understand. So I'm just going to type in Google a name. So we're going to do DNN stock. Okay. So we pull this up. It's got a market cap of $1.13 billion. Let me move me up here. So it's at 1.13 for DNN, Denison Mines. What does that mean? Now, if you were to look at the shares, the outstanding shares that a company has, it's how many shares are issued out there, the total amount. And if you multiply the total amount of shares times your share price, that is your market cap. That is what the company is valued at. So it's the value of the share. For this particular one, it's at $1.41. And if you wanted to know how many shares they had, what you could do is we know it's at 1.3 billion, right? Right there. And you divide it by 1.41, and that's how many shares they have, roughly 801 million shares. Now, some people, they look at the price. They'll look at a UU, they'll look at a Bannerman, they'll look at some of these companies and they'll say, well, last bull market, it was $4 or $10 or whatever it is. You can't use that price because between then and now, they diluted their shares. UU diluted their shares a lot. And what does share dilution mean? It means that they raised money by issuing new shares at a certain price. And now the share count went way up. So if you went from a 500 million 500 million share count to a billion, so you doubled your shares, when you go back up, your share price will be half as high. Does that make sense? So in order to be the same market cap, your share price will be half as high. Market cap is really what determines how big your company can be. So you've got, if you're at a 1 billion market cap at the peak, but you only had 5 million, here, I can throw some numbers here just so you guys, if you understand the world through numbers, maybe. So I'll move this over. So if your share price was like $4, right? And you had 500 million shares, you divide it by, it's 4 times 500 million. 4 times 500 million. So you've got 2 billion shares. Is that right? No, 2 billion market cap, sorry. So that's 4 share price. You have 500 million shares, and your market cap at that time was 2 billion. But if you increased your share count from 500 million to a billion, your share price gets cut in half. So if you're going to do a comparison, and you want it to be an equal comparison, you have to look at what would their market cap be at the peak of 2011 and divide out the market cap by what their market cap is today, and that's what the potential share price could be. You can't do the same, like look at history and then look at today's share price and compare it, because the share quantity is different. The total outstanding shares is different. So the number of shares times your price determines your market cap. Your market cap size, the actual physical size, in this one it's 1.13 billion. It's easier to grow a 100 million market cap than it is to grow a 1.13 billion market cap. But it also depends on the opportunities that the company has in front of it to grow. Now, the sweet spot for me, I like to look at market caps that are smaller. They can grow much easier. And it depends on, if you're a well-diversified mining company and you own a whole bunch of different mines already, like a Rio Tinto, it's going to be harder to grow that company faster because you're going to have to grow a gigantic base already. It'd be like Apple trying to grow 100 times in value. Everyone already owns cell phones of Apple and everything. It's hard to grow another 100 times on top of that if everyone already owns it. It's the same thing with any company. If they already have a bunch of mines and they're big mines, they're going to have to replace their big mines and then grow above it. That's very hard to do. Versus a company that doesn't have anything, it's valued like it has nothing, and then it finds a huge mine, and all you need is one big mine, and that can grow quite substantially because of the value that's created for shareholders. The value is created in two ways. I've described this before. The first value is finding a deposit. Increasing your pounds in the ground is value for shareholders. The second spot that you can find value is you have your pounds in the ground and you make those pounds more expensive. So you go from an exploration stage to a producer stage, and the value of those pounds in the ground by the market will increase the value because it will be valued like an explorer versus a producer. And that valuation could range from, a 1x, like you're only getting 1 times whatever the unit of measure is, all the way to a 6 or 8x, depending on what value and how easy it is to extract out of the ground. So that there is value creation for shareholders. The way that I view things is if you've got a really good management team and you have a smaller market cap, what you're doing is you're increasing your odds of a very high return, and I'm just throwing some money in them. Now, what companies? You're going to say, what companies are those that are good management teams and smaller market caps? Encore Energy, I do like that one. Let's see what its market cap is. I haven't looked in a while. It is 285 million market cap in Canadian. So that's still pretty small. It's not too bad. I can't remember how many pounds in the ground they have off the top of my head. It's like 70 million pounds probably. So if you were to do the math, I think it's 70 million. It'd be 285 divided by 70 is you're paying $4 a pound. So you're in the middle. You're in the middle of the valuation. Goviax, what's Goviax at? GVXXF. Goviax is at 150 million. I think they have 250 million, 225 million. 151 divided by, let's just say 225, 67 cents a pound. So that is being priced like they have problems or they're in an area. It's very cheap in relationship. Now, Bannerman's got like 200 million pounds, and I think they're BNN. And remember, these are kind of lower grade, not as good of properties. 163 million. I think they have over 200 million pounds, possibly. So that's under $1 as well. Now, I'm not saying that these are the best ones. I'm just saying that on a dollars per pound, they are cheaper. But I wouldn't base it solely off of that metric. I do like Brandon Monroe though, so Bannerman. I threw some money in there just to let it ride. Now, I know a lot of people they look at this, they'll hit max, they'll say, look at this, it was over $1 back here, and now it's only 14 cents. Could it go back to $1? And it very well could, but the valuation of its market cap will be larger at $1 than it was back here if they diluted shares in between here, which they did. I don't know how much they've diluted shares, but you'll be at a larger market cap at $1 than it was back in 2010, 2009, or, well, let's see. back in 2009. But it very well could get up there, depending on the price of uranium. And remember, these companies that have higher costs, we'll call it cost curves. They are $50 a pound, $60 a pound. They're gonna lag. They're kind of lag, and then the uranium price goes up. And then once it goes past that $60, and if they are producing, or they're going to start to produce, and they're ramping up, those dollars per pound in the ground they're going to go up quite a bit. You're going to get a good revaluation of value of those pounds in the ground, because they're going to become more valuable if they're valuable to mine. The more valuable they are to mine, if you can bring it out and produce it, they're going to become more valuable. And if they put the effort in, Bannerman, to produce, they're going to become a lot more valuable than where they are today, depending on the price. Depends how long that price stays up there too. So I take an approach of buying some high cost producers, some lower market caps, and then I buy some mid market caps with low cost, like a NXE is getting up there. It's a mid to larger cap, and then I spread it out. That's what I do. And I have found that if you take what you consider to be the best bets and spread it across what you think are the best bets, that is the best bet, because they outperform the ETF dramatically. I mean, absolutely destroy the ETF in terms of returns. So hopefully this helped you guys out. Now you should be able to understand what market cap is, which is total outstanding shares times share price equals your market cap. Your market cap is what if you double in share price, you double in market cap. That's your market capitalization. If you have a very large market cap, it's very hard to double a large market cap versus a very small market cap. And I choose companies based off of a multiple of things. Management, I do look at some of these that are cheap on a dollars per pound basis. And then I look at some of the explorers and kind of sprinkle in just a little bit of money in case somebody hits something. If you guys like this content, give me a thumbs up. Hopefully you guys understand it better. If not, please put it in the comment section. I can go over whatever you guys need help with. And thank you for listening. This is Finding Value.